Welcome back to the deep dive. Today, we're stripping away all the noise. We're looking at the year ahead 2026 and focusing on the one metric that really defines your financial health.
Not salary.
Not salary, not credit scores. We are talking about net worth.
It really is the only scoreboard that matters.
Okay.
I mean, you can earn $1 million a year, but if you spend $1 million in one, you're technically broke. You're fragile.
Exactly.
But net worth, that's the measure of stability. That's freedom.
Right. And to help us get there, we've pulled together a really specific stack of research. We're looking at behavioral psychology, the latest 2026 tax code updates.
And even some strategies from the venture capital world.
Exactly. You're on the Smart Capital School channel.
And I want to be really clear right out of the gate. This is not a get-rich-quick conversation. We are not telling you to dump your savings into some meme coin.
No. This is about structure. We've identified 10 specific levers you can actually pull. Some are psychological, literally hacking how your brain processes spending.
And others are just pure math.
The premise is simple, right? You don't have to do all 10 of these things perfectly.
No, not at all. The thinking is that applying just one of these could shift your whole trajectory. But if you stack them, if you combine the psychology with the tax strategy,
That's the snowball effect.
that's it.
So let's get into it. Strategy number 1. This is a behavioral guardrail called the 1% rule.
Right. And this isn't about being in the top 1%. It's all about impulse control.
Okay, explain that.
Well, we live in an economy that is designed to separate you from your money, right? Every app, every ad, it's all optimized to make you buy something right now. The 1% rule is just a friction mechanism. It says that if you want to make a non-essential purchase that costs more than 1% of your total net worth, you can't buy it.
You can't buy it at all.
Well, you can't buy it immediately. You have to wait.
Okay, so let's break down the math on that. Let's say someone is just starting out. Maybe they have a net worth of $20,000.
Okay, so 1% of 20,000 is $200. If they see, I don't know, a new pair of headphones for $250, they trigger the rule. They have to wait. The recommendation is usually a week, maybe even a month.
And if you're a bit further along, say someone's built up a $50,000 net worth.
Then the threshold is $500. And that's the beauty of it. It scales with you. As you get wealthier, your fund money allowance expands,
Yeah.
but it never outpaces your wealth accumulation.
It keeps your lifestyle tied to your wealth, not just your income.
Exactly.
Okay, but I can hear people saying it's just $200. Is denying myself a pair of headphones really going to make me wealthy? It feels like we're pinching pennies.
Well, it's not about the headphones. It's about the opportunity cost. And the data here it's just staggering.
Okay.
If that person with the $20,000 net worth applies this rule consistently, they're probably saving about $200 a month on junk they didn't really need.
Which is, what, $2,400 a year? That doesn't sound like retirement money.
In a vacuum, no.
Yeah.
But if you take that $2,400 a year and you invest it, say in a standard S&P 500 index fund, over a 40-year career, that single habit turns into an extra $671,474.
Wait, run that by me again. Over $500,000.
$671,000. That is the power of compound interest. You aren't just spending $250 on headphones, you're spending the future growth of that money.
Wow. That puts it in a totally different perspective. Makes that impulse buy feel a lot more expensive.
And there's a key nuance here. This rule is most important for that first $100,000 of net worth. That's the grind phase.
Right.
Once you're past, say, $100K or $200K, you can relax the strict math a little. Because by then, you've already built the muscle of delaying gratification.
So it's like training wheels for your wallet. Okay, let's pivot. Strategy number 2. This moves us from saving to how we actually earn. The source material talks a lot about Naval Ravikant here.
Yeah, this is a fundamental mental shift. The core insight is this. You cannot get rich renting out your time.
That's a terrifying thing to hear because that's what 90% of us do. We trade 40 hours for a paycheck.
It's what we're all conditioned to do. And the trap is that even super high earners fall for this. Think about a specialized surgeon or a corporate lawyer.
Right. They're making $300 off $400 an hour. Huge incomes.
Huge incomes. But they often aren't truly wealthy.
Why is that? Just lifestyle inflation.
That's a big part of it, for sure. But the structural problem is fragility. If that surgeon breaks her hand or just burns out and wants to take a year off,
The income goes to zero instantly.
the faucet just turns off. They're still trading time for money. It's just really, really expensive time.
So what's the alternative? We can't all just quit our jobs and start the next Google tomorrow.
No, and you shouldn't. But you need to shift your focus towards things like equity or business ownership, or even just a pay structure based on output instead of hours.
Give me a tangible example of output-based pay.
Sales is the classic one. A real estate agent, for example. It takes roughly the same amount of time and effort to sell $1 million house as it does to sell a $3 million house.
But the commission check is triple.
Exactly. Their income is detached from the hours they put in and attached to the magnitude of the result. That's leverage.
Now, I have to be the devil's advocate here. Commission-based work, that's risky. If you don't sell, you don't eat.
That is the trade-off. It requires a ton of self-discipline. It is not for everyone, but the math is clear. If you want to really grow your net worth, you have to find a way to disconnect your earnings from the clock.
You need to be making money while you sleep.
That's the goal.
Which leads perfectly into strategy number 3, because sometimes money doesn't come from a sale or a clock. Sometimes it falls into your lap. Windfalls.
The found money problem.
Yeah, and the source calls this the 90-10 rule, because let's be honest, what's the first instinct when you get a $3,000 tax return?
For 99% of people, the instinct is free money, let's book a vacation.
Right, because we treat found money so differently than earned money.
It's mental accounting. So the strategy here is to hack that impulse. You take 10% of that windfall, so $300 in this case, and you blow it. Guilt-free, go to the fancy dinner.
You scratch the itch, you get that dopamine hit.
You scratch the itch. But the other 90%, the other $2,700, you pretend it never existed. You invest it immediately.
And I'm guessing the compounding math on this is pretty powerful too.
Oh, it's profound. If you get a $3,000 windfall every year, like a tax return or a bonus, and you invest that 90% over 20 years, that loan is an extra $133,000.
Wow, just from money you weren't counting on anyway.
Exactly.
Okay, let's look at the other side of this. We've talked about saving. Let's talk about earning more. Strategy number 4 is about the gap.
The gap is just income minus expenses. You have to widen that gap. And while cutting spending helps, boosting your income is, well, it's uncapped.
Right. You can only cut so much, but you can always earn more.
The source brought up some data from Lending Tree on job hopping that I found fascinating. The old advice was always stay loyal, climb the corporate ladder.
That advice is, it's obsolete. The data shows that staying at one company usually gets you a salary bump of about 5% to 6% a year.
Which barely keeps up with inflation sometimes.
It's switching jobs.
The average bump for switching to a new company is 15%. And honestly, in fields like tech, it can be 20, 30% higher than what current employees are making.
Why does that happen? Why wouldn't a company just pay their loyal people the market rate to keep them?
It's called the loyalty tax. The company knows you've already accepted your current salary. They have you. They have no real incentive to just voluntarily raise their costs by 20%.
But for a new hire, they have to pay the going rate to get them in the door.
They have to pay the 2026 market price. So in purely financial terms, yeah, loyalty is costing you money.
But you need the skills to make those jumps, right?
This is key. And we're not talking about going back to grad school for 2 years. We're talking about skill stacking. Things like data analytics, SQL, video editing.
Or even the trades. I hear welders and electricians make a killing.
Absolutely. The ROI on learning a skill like SQL for 3 months of evenings and weekends can be a $40,000 salary bump. It's an incredible investment.
Wait, let's pause for a second here. We're throwing a lot of numbers and strategies at everyone.
Yeah, a ton of info.
And we really want to make sure these deep dives are hitting the mark for you. So leave your suggestions in the comments about what topics you'd like to hear in future videos.
We want to know what your pain points are.
Exactly. We build this show around you. Okay, back to the list. Strategy number 5. This one seems almost too simple, but the data says we are just failing at it. Tracking.
You can't improve what you don't measure. And something like 67% of Americans do not track their net worth. They might check their bank account, but that's not the same thing.
What's the real distinction there?
Your bank balance tells you if you can buy groceries this week. Your net worth tells you if you can ever stop working. It's your assets minus your liabilities. It's the whole picture.
I think people avoid it because it can be scary, right? If you have student loans, that number might be negative for a while.
It might be,
Yeah.
But you have to face it. The recommendation isn't to obsess over it daily, though. That just leads to anxiety. The sweet spot is quarterly tracking.
Every 3 months.
It's frequent enough to see if you're heading in the right direction, but not so frequent that you panic over a single bad day in the market.
It smooths out the noise. Okay, so if you're tracking it and notice the line is flat, even after that big raise we talked about, you're probably dealing with strategy 6's big enemy, lifestyle creep.
The silent wealth killer. Or, keeping up with the Joneses. Except in 2026, the Joneses are on Instagram, and they're probably drowning in debt.
The source had some really specific numbers on the big 3 expenses. cars, housing, and vacations.
These are the big levers. If you get these three right, you can buy all the lattes you want. If you get them wrong, nothing else matters.
Let's hit the car data. AAA's numbers were shocking.
The total cost to own a new car is now $11,577 per year. That's almost $1,000 a month when you factor in the payment, insurance, gas, and the big one, depreciation.
And housing.
Bankrate says the average cost for upkeep and ownership, and this is on top of your mortgage, is $21,400 a year.
So you get a $20,000 raise, you feel rich, you upgrade your car, you move to a slightly bigger house.
And you take a trip to Europe, and poof, you've actually become poor. You've committed all your future cash flow. You're just running in place on a more expensive treadmill.
The strategy is just delay the status purchases.
The new car smell fades in 3 weeks, but that payment lasts for 6 years. Just keep your capital compounding instead.
Speaking of keeping your capital, let's talk about the government's share. Strategy 7, tax optimization.
This is where the wealthy really separate themselves.
Yeah.
It's not about what you make, it's about what you keep. For 2026, you got to know the new limits.
Give us the cheat sheet.
401k limit, $24,500 if you're under 50, jumps to $32,500 if you're over. For IRAs, it's $7,500 and $8,600.
But the strategy isn't just filling the bucket, right?
No, it's what you do inside the bucket. These accounts are tax shelters. They let you trade and rebalance without triggering capital gains taxes every time.
Okay. What about losses? I've heard of tax loss harvesting. Sounds really complicated.
It's actually gotten pretty simple. A lot of robo-advisors just do it for you now. But essentially, if you have an investment outside your retirement account that's down, you sell it.
You lock in the loss.
You lock in the loss on paper. Then you immediately buy a similar but not identical asset so you stay in the market. But that loss you just realized, you can use it to offset other gains or even up to $3,000 of your regular income.
So the government kind of gives you a discount for losing money.
In a way, yeah. It lowers your tax bill. It's turning lemons into lemonade financially.
I love that. Okay, let's move to something a bit more social. Strategy number 8 is negotiation.
Everything is negotiable.
The notes had a funny story about a guy negotiating the price of meat at a butcher shop.
Yeah, his logic was, if you don't sell this steak by Tuesday, you have to throw it out. So sell it to me now for 20% off.
And it worked.
Apparently. But look, you don't need to be that guy. Please don't hold up the line at the grocery store.
Right.
But you must be that guy with your service providers. Your cable, your internet, your insurance.
A single phone call.
One 15-minute call can save you $600 to $1,000 a year. These companies have retention departments whose only job is to give you a discount so you don't cancel.
But the really big one here is salary negotiation.
This is the million-dollar conversation, literally. Negotiating a starting salary just $5,000 higher seems small, but all your future raises are percentage-based.
So that initial $5,000 just compounds every single year.
Exactly. Over a career, that one awkward 10-minute conversation can be worth an extra $59,000.
That's incredible leverage. 10 minutes of discomfort for 60 grand.
You just need to know your number and be willing to walk away. If you can't walk away, you're not negotiating, you're begging.
That's a tough truth. Okay, strategy number 9. We've done the hard work. Let's make it easy. Automation.
This is all about removing the human element. Decision fatigue is a real wealth killer. If you have to choose to save money every single month, eventually you'll have a bad day and you'll choose not to.
So you take willpower completely out of the equation.
You build a machine. You set up automatic transfers for the day after you get paid,
Why the day after?
just to make sure the funds have cleared so you don't overdraft. But the moment that money is available, it gets routed to the 5 buckets.
Now break down the buckets.
Utilities, rent or mortgage, credit cards, savings, and investments. The money moves before you even see it. It creates an artificial scarcity.
So you look at your checking account and think you're broke, but in the background, your wealth is actually building.
The only way to guarantee consistency. Willpower is finite. Automation is infinite.
Which brings us to the final strategy. Number 10, infinite ROI.
Financial literacy.
That sounds a little cliche, ending on read a book.
It might sound cliche, but it's the highest leverage activity you can possibly do. Knowledge compounds faster than money.
Explain that.
Think about this deep dive. If you learn just one thing today, say how tax loss harvesting works, that one piece of information could save you thousands of dollars over your lifetime. Your investment was, what? 20 minutes of listening? The return is thousands of dollars.
That's an infinite ROI.
It is. And the best part is the barrier to entry is basically zero. You don't need expensive seminars. Podcasts are free. Libraries are free.
So if you're listening to this, you're already doing strategy number 10.
You're already winning. Wealthy people view their mind as their primary asset. They're constantly upgrading their own operating system.
So let's bring this all home. We've covered a ton of ground. The 1% rule, uncoupling time from money, the 90-10 rule for windfalls, widening the gap.
Tracking, fighting lifestyle creep, tax optimization, negotiation, automation, and education.
They all work together, don't they?
It's a whole ecosystem. You can't just pick one and ignore the others. If you earn more but let lifestyle creep eat it all up, you get nowhere. If you save but don't invest it smartly, inflation eats you alive.
So what's the big takeaway for 2026?
It's that wealth isn't magic. It's not about luck. It's a boring, predictable result of discipline, structure, and psychology.
And that's empowering. It means it's actionable. You don't have to be a genius. You just have to be intentional.
Intentionality, that's the word of the year.
I want to leave everyone with one final thought. We've used the words rich and wealthy a lot today, but they're not the same thing, are they?
A huge difference. And this is a thought I want you to walk away with. Rich is your income. It's the car, the salary. It's what you show people. But wealthy is hidden. Wealthy is owning your time, is having assets that pay for your life so you don't have to sell your hours for a paycheck.
So which one are you optimizing for? The high score on the W-2 or the freedom on your calendar?
That's the question for 2026.
I think that is the perfect place to leave it. We hope you got a ton of value out of this deep dive. Subscribe to the channel, like it, and see you in the next analysis.
Goodbye, everyone.